Good evening. It is Dan Kerr's DK Analytics. It is Monday, March 9th, 2020. I'm chiming back in here with a video that I've titled The Quickening. I think you know why after what happened today and last week. Um, Before I get into some thoughts, let me quickly go through some valuation metrics. The trade weighted US dollar stood at 116.9, now coming under pressure. The US 10-year, unbelievable bull market here that has sent the yield all the way down to 0.56%, absolutely unprecedented and very rapidly that this explosion in the bond price, fall in the yield took place. I'll get into that. The S&P 500 down sharply again today on the heels of last week's weekdays at 27.46. Oil got absolutely clobbered, I believe, a record decline, one day percentage decline in the oil price, closed at 31.01 per blue barrel dollars. Gold and silver edging up, but not really reflecting the panic and the flight to safe havens that one would expect. I think I've gone over why, but I think this will change. Gold closed at 16.75 per troy ounce and silver at $16.85 per troy ounce. The S&P today gapped down over 200 points or 7% at the open and closed at 27.46 as said, which was down 226 points or 7.6%, the steepest one-day drop since 2008. Given the sustained implosion of global stock markets and a historic decline in the oil price, which was down again a shuddering 24.9% from Friday's closing price, I want to jump in with a few observations and push aside for the moment the video that I want to do on corporate anorexia's long tail impact on both solvency and growth prospects. Let me jump right in and start with oil. The price of oil is being pummeled by the demand-culling behavioral fallout, which the coronavirus-induced lockdowns, canceled travel, canceled events like the most prestigious car show in Geneva, and lots of spillover effects across the globe, and also canceled business conventions. Anything that requires travel and meeting of a lot of people has in essence been reduced sharply, with large impacts, multiplier impacts on the supplier industries. And as travel and hotel or leisure are 10 to 20% of most OECD nation economies, if these things get clocked by 40, 50%, well, by definition, you'd have a recession overall already. Besides this demand-culling behavioral fallout, we also have a market share war where the Saudis have decided to open their spigots to, in essence, bankrupt or finally put out of business America's high-cost, loss-making shale oil extractors on the one hand, and against Russian extractors / oil companies on the other hand. Given the extensive financing provided by U.S. banks and investors, as well as the shale industry's extensive oil price hedging for this year, this will exert additional earnings and balance sheet pressure on those financial constituencies that provided the funds and are exposed to the hedges. And as the financing sector is by now, given the financialization of the economy of America and much of the West, the biggest industry of all, this is not to be brushed aside. By the way, it's one more thing on oil. Recently, a statistic came out that only 20% of the oil consumed was actually extracted. In other words, newly found oil, which is pretty par for the course. In fact, that's, I think, is a high watermark. It might be even lower, or it has been lower than that year after year. So we're only replacing a fifth or less of the oil we consume each year, which is not how you spell sustainability. Um, my bigger point is the current oil price route will eventually prove to be a great purchase opportunity. A supply story, in short, spiked by unprecedented fiat currency debasement in the wings, even much more outrageous than we've seen. And why a supply story? Because oil is essential to leveraged output, and most of the products we see have oil or natural gas in them. And you cannot have leveraged output or productivity without oil, and you can't have a travel industry without oil. You can't have agriculture without oil and gas, so on and so forth, at least not in the output terms that we're used to, and that's what this is all about. Because if productivity goes down, output goes south, and so does the bottom line, which disappears entirely and turns into losses. Investment grade government bonds are also plummeting. Bond yields, rather, are also plummeting nearly as sharply as the oil price. Actually, you could say even more sharply, given that at the end of last year, we were at 1.92% yield on a 10-year treasury, and we're now at 0.56% yield. I mean, these are all-time lows. It's unprecedented, and it's happened with, the yield has crumbled with unprecedented and increasing speed. Meanwhile, the spread that junk corporates, BB rated and less, have to treasuries is widening sharply. In fact, it was up 120 basis points to 3.3 percentage point spread within 1 week. I had mentioned the spread widening in earlier videos as a canary in the coal mine. Well, that indicator has also failed to be a leading indicator and has become a coincidental or even a lagging indicator, what with or despite the $3.2 trillion expansion in non-financial corporate debt in the U.S. since 2008, and an alleged 20% of all public U.S. companies that are unable to service debt obligations out of their current rapidly dropping cash flows, much less their earnings. They're also known as zombie companies. So with that as a background, you would think that corporate yields, especially non-investment grade, would have been spiking far in advance of this corona manifestation. Meanwhile, the yield curve, as we all know, continues to invert, which threatens banks' liquidity, solvency, and margins. Banks borrow short and lend long. If the margin collapses or goes negative, how can bank profits do well? Thus, the Fed is busy underpinning the repo market with record purchases and is buying short-term treasuries like a scalded dog. $60 billion per month with likely upward revisions in an effort to return to a positive yield curve. Stout intervention in the repo market and short-term treasury market, an effort to try to bring that complex in to heal with the Fed funds rate, which has just been dropped by 50 basis points to, I think, 1.2%. Let me show you some charts to bring this a bit closer. And I'm going first to the overnight repo purchases. Let me get this on the camera here. Here we go. It's turning a bit dark here. I hope the shadow I cast with my hand isn't too severe. But these are the overnight repo purchases. That's today, March 9th, 2020. And that's this jagged line up, okay, right here. In 1 day today, the Fed purchased overnight repos worth $113 billion. And you might recall that the repo market got unsettled, that is, exceeded the Fed funds rate, the dictate rate on the short end, thanks to banks increasingly distressing their balance sheets, their liquidity, and also they lend to the Wall Street high flyers, the hedge funds, private equity in their ilk, who obviously have had issues with some of their speculations, many of which are leveraged, performing as they should, whether it be unicorns or long-term junk bonds. And so the banks that have refused to lend, both due to mistrust in each other as well as increasing mistrust as far as the hedge funds and private equity firms that then take those short-term funds and enter into an asset liability duration mismatch, which always happens. But in this case, their dependency on this ultra low rate juxtaposed against assets that are leveraged and increasingly speculative gave everybody cold feet. So the crybabies on Wall Street had to be bailed out by the Fed. And that's how that happened and is now being doubled down on because of the increasing liquidity issues of the market, given the stout drop in the stock market and the huge rally in investment grade government bonds, which is what brings us the inverted yield curve. Okay, the other part of the Fed's hyperactivity, despite not doing any money printing or quantitative easing, is right here. The Fed's balance sheet on Friday, that's March 6th, 2020, rocketed higher over 1 week, less than a week from the Wednesday before, by $83 billion in 1 week, right? And these, again, these are short-term treasuries that they're buying. They're trying to bring the short-term rates down below the collapsing long bond yield. And they're going to spend enormous amounts of money to do it, to keep the financial system up and running, as mentioned. But if you took 83 billion, multiply that times 4 weeks, I mean, you're looking at an excess of 320 billion per month, which I think we're going in that direction, not in a straight line, but that's where we're going. And that would hugely exceed any of the official QE, which of course we're not having now, of 60 to 80 billion a month. So you see where we're going, off the deep end. And I think this is a preview of coming attractions, not just in the US, but around the world. Let me get back to the quickening. That is an accelerated decline in certain asset values or prices. A US stock market rally, which until recently was fueled by stock buybacks. That's the LBOing of the Standard & Poor's 500, part and parcel of the corporate anorexia that I'm going to drill into more deeply. That really doesn't bode well for future growth, but that's another story. If that huge stock buyback program that's been ongoing, thanks also to the repatriation of U.S. profits at lower tax rates afforded by the Trump administration, if that and record margin debt start to become factors that will pull the market down, stock market down, meaning less stock buybacks, these companies are going to have to issue shares at much lower prices, which always happens too. But we have stock buybacks, the treasury shares are not increasing by the same amount, will turn into sales, if anything, of treasury shares, and record margin debt till very recently. In other words, a lot of people are punting on stocks and being on board the Trump Express to ever higher stock market valuations. That is now triggering margin calls with a precipitous fall in the stock market. That means those that can't meet margin calls have to sell stocks. So we've got less buybacks and more stock sales that could flip this previously positive dynamic underpinning stock prices. Separately, with cronyism, that is big business in bed with big government, ever more rampant, and Main Street makers increasingly locked out of contracts and financing, even as those same makers footed larger and larger crony bailout bills all the way back decades ago, from the S&L bailout to the more recent TARP bailout, which in essence is financed on the back of U.S. or Main Street makers. With this in play, small business that faces contracting top lines will likely be starved for cash, which adds huge pressure to a crumbling economy. Why? Because small businesses are still the backbone of the economy, and it's where most people in the private sector are employed. In short, we may soon face a liquidity crisis on top of a solvency/debt crisis. I've often commented on the extreme, roughly 3 or 4 to 1 increase in debt, both in the US and globally, as compared to GDP growth. And this cannot just be swept under the rug. In any case, liquidity crisis heaped on top of a solvency debt crisis, those zombie firms, consumers in trouble with student loans, car loans, what have you, this will further pressure economic activity to the downside, which would punish corporate earnings and could precipitate a sustained stock market correction fed by momentum investing in reverse, algos spitting out yet more sell orders, and by ETF groupthink allocations pressuring wide swaths of market sectors that rallied so sharply previously. And last but not least, by technical analysis, downside sell confirmation, such as stocks moving below their 30/60/120-day moving averages. In short, the demand bullishness for stocks appears to be morphing into sustained share sales. And this is prior to expanding share sales coming from an aging population, which will further pressure PEs to the downside. The demographic PE compressor is just getting revved up. And one explanation, there are always as many buyers as sellers. But if too many people want to sell, then the only way to make that happen is to have a lower share price, right? It's the opposite of when if there's too much demand, it's reflected in a higher equilibrium price. If there's too much in the way of sales, well, then the clearing price is to the south, pressure on stock prices. In the interim, the ongoing flight to perceived safety, such as U.S. Treasuries and other OECD investment-grade bonds from Japan to the Netherlands to Germany to Switzerland, this has resulted in absolutely record-breaking low yields and or steeper negative nominal yields in record-breaking time, as previously mentioned. The increasingly palpable, increasingly widespread investor fear, even panic, as typified by disappearing investment-grade yields, should set the stage for another dead cat bounce opportunity in the stock market, which would give investors another chance, hopefully, to lighten up on overvalued stocks bought at dear prices. Meanwhile, and this may continue to sound controversial, I've been wrong so far, confession, today's record low investment grade government bond yields are also a chance to lighten up on a sector, bonds, which has been in a secular bull market for the better part of 4 decades. For some graphic flavor, consider that the yields on the 10-year and 30-year treasuries topped out at 15.8% on the 10-year in 1981 and at 15.2% in September of 81 as regards to 30-year bond, over 15%, nearly 16 on the 10-year. We're now below 1% yields on both bonds. In fact, the 30 years down to an unthinkable, unprecedented 0.94%. The takeaway, and I know again I've said this at substantially higher yields of 2 to 3%, investors should consider reducing exposure to 10 and 30-year treasuries because they have huge risk in terms of duration risk, in terms of inflation risks, and in terms of solvency risks. Investors, by extension, should also consider taking gains on Frankenstein finance long government bonds featuring negative yields in those countries just mentioned, Japan, Germany, the Netherlands, and Switzerland. The bond reallocation story here is actually deceptively simple. Realize capital gains, take the proceeds, and invest in short-term investment-grade government securities, bonds that sometimes sport higher yields, thanks to the yield inversion, have no duration/interest rate risk, and cannot be bailed in, like your bank deposits can be, and you all of a sudden think you have a deposit and you end up holding an equity stuff, right? Can't happen with government bonds. Or, if it's still possible, just ask to be paid in cash and place your notes in a very safe, accessible place. But do realize that currency in circulation is a single-digit percentage of the money supply in virtually any OECD country. In addition, consider dipping your toe into the battered oil and gas sector, but focus on plays/companies that have relatively sound balance sheets, relatively low cost structures, and a relatively good reserve status. That's not an easy thing when we find year after year only a fraction of the oil that we consume, right? Given the declining property right protections in OECD countries and much lower valuations and debt encumbrances at the Russian country level and in select Russian oil and gas plays, not to mention a ruble that is still on the floor, don't get scared out of potentially investing in oil and gas assets in Russia. You could profit from a great secular supply story. The world doesn't work, the leverage doesn't work, the products aren't there without oil and natural gas. That gets another lift if you buy the appropriate Russian companies. It gets another lift beyond the secular supply lift from a strengthening ruble that reflects Russia's much better than OECD finances, because it in essence had to wean itself from the dollar. A rapidly deteriorating economic, financial, and political fundamentals prior to the coronavirus impact are now going rapidly from bad to worse, yet widespread stock bubbles, and especially bond bubbles, remain. It's beginning to look a lot like this is the real asset valuation reset deal, don't you think? And that we may only be in the first inning of what will likely prove to be a historic reset, which will ultimately massively revalue stocks and bonds to the downside while revaluing real money, silver and gold, physical form, and scarce, vital real assets to the upside. Once again, I think we will be sailing or are sailing into a deepening global recession plagued by unprecedented fiat currency creation, the unprecedented debt that it bestowed upon us, the unprecedented misallocations courtesy of our global central banks, and the increasingly widespread productivity shortfalls which reflect all that ugliness. So the difficult progeny of fiat money center banks that are bent on currency destruction will be very hard to shape up. Needless to say, leading global central banks will continue to respond to their unruly children with yet more fiat currency debasement until they have destroyed confidence in counterfeit currencies. Why? Simple. Because leading Central bankers want to keep their unrivaled power, prestige, and privileges. They want to keep their racket going as long as possible. That's why. Our predicament and our central banksters doubling down on more widespread money printing, which could see more widespread stock purchases. It isn't just, won't necessarily just be Switzerland and Japan. Yellen suggested that the U.S. central bank, the Fed, should also consider supporting equity valuations. We can have direct bailouts of industries in trouble, maybe the hotel industry or the travel industry. Or we could send checks directly, that is, the central banks could, to consumers, not worry about banks reinvesting them onto the central bank's balance sheets. Or such other Keynesian calamities, which always misfire and make a bad situation worse. They threaten together in aggregate to bring us a more virulent version of the 1970s stagflation and a much more savage stock and bond repricing, given the epic valuation bubbles we have still juxtaposed against collapsing growth, profits, and solvency ahead of what will likely prove to be an atypically long recessionary funk that may result in investors again demanding extremely attractive valuations in order to invest, especially given the large demographically / aging based bond and stock sales pressure increasingly in the pipeline. Finally, and I know I sound like a broken record, but remember that markets are reversion beyond the mean machines. We spend hardly time at an average S&P 500 PE of 16 or an average 10-year treasury yield of approximately 4%. We slice through these valuations. On the way up in equity bull markets in stocks, and we compress well below them in bear markets in stocks, such as with single-digit PEs that are accompanied by double-digit bond yields and the eviscerating discount rate that brings to bear upon stocks that have present value. Just think back to the 60s, the 70s, and the early 80s for valuation flavor, also known as a 12 to 13-year bear market in bonds and stocks. After decades of bullish valuations in bonds and stocks, they, as you know, travel together most of the time, the discount mechanism. We are now set for bust valuations that may well be with us for a long time, given the damage central banks have done or enabled. Oh wait, one more thought. If you layer much lower PEs that will ultimately reflect, stock PEs that will ultimately reflect a bond bear market onto what may be sustainably reduced earnings power or earnings per share, then you have a valuation at risk double whammy. Specifically, lower EPS and higher discount rates. Quite the stock valuation pressure cooker. The 70s stagflation on steroids around the corner. I think the odds of that happening are higher than 50%. I hope you found the quickening observations worthy of your time. This is Dan Kurz of DK Analytics. It is March 9th, 2020, and I'm trying to find the sign off button here before I pull the plug. I apologize for this lagging ability to shut the video down. Found it. Bye-bye.